In the world of investing, we're all kind of looking for that perfect balance, right? Something a bit safer than the wild roller coaster of the stock market, but, with better returns than what you'd get from a plain old savings account. Well, today, we're going to dive into an asset that might just hit that sweet spot: investment grade corporate bonds.
I mean, does this question sound familiar? It's the classic dilemma for pretty much every investor. We want our money to grow, for sure, but we also crave that stability so we can sleep at night. This is exactly where investment grade bonds come into the picture, offering a really fascinating middle ground between those two big goals.
So let's start at the beginning. What in the world are investment grade bonds? The subtitle here calls them the blue chip of bonds, and honestly, that's the perfect way to think about them.
At its core, it's actually really simple. When you buy a corporate bond, you are literally lending money to a company. Now, the investment grade part means you're lending to a very, very reliable and financially solid company. Think of it as a loan with an extremely high chance of being paid back, plus interest.
So how do we know they're reliable? Well, it's not just a gut feeling. As you can see here, there are big, trusted agencies, like S&P and Moody's, that give these companies a credit score, just like you have one. To be called investment grade, they need to hit at least a BBB or a Baa 3 rating. We're talking about the titans of industry here: your Apples, your Microsofts, your TSMCs, companies that are known for having rock-solid finances. And that level of quality leads us straight to their main appeal, which is finding that perfect sweet spot between risk and reward. It's kind of like hitting the golden cross for your portfolio. The entire reason people are drawn to these bonds really just boils down to one thing: a unique and powerful balance that's actually pretty hard to find anywhere else in the investing world. So let's put that in perspective. On one side of the scale, you have high-yield bonds, which people often call junk bonds. Yeah, they offer higher interest, but there's a good reason for that. There's a much bigger risk that the company might just fail and not pay you back. Investment-grade bonds, on the other hand, are all about protecting that initial investment you made. Then, on the other end of the spectrum, you have government bonds, which are about as safe as it gets. But all that safety comes at a price: lower payouts. Investment-grade bonds slot right into that perfect middle. You're taking on just a tiny bit more risk than a government bond, so the company pays you a higher interest rate to make it worth your while. This really is the sweet spot we've been talking about. You're getting a more attractive income stream than government bonds typically offer, but you're not taking on the scary risks that come with junk bonds. It's just a really compelling middle ground for a lot of people. But here's where it gets even more interesting. Beyond just generating income, these bonds have this awesome, versatile dual nature. As this slide says, they can play both offense and defense in your portfolio. All right, let's talk defense first. When the stock market gets all choppy and volatile, and you know it does, investors often go running for safety. Because these bonds are so stable and offer reliable payouts, they can act like a safe haven, helping to cushion your portfolio when stocks take a dive. Okay, now for the offense. This is all about seizing an opportunity. See, investment-grade bonds are sensitive to changes in interest rates, and that creates a chance to make money beyond just collecting those regular interest checks. Let me show you how. Okay, here's how it works. Let's say you own a bond that pays you 4% interest. Then the central bank announces they're cutting rates, and all the new bonds being issued now only pay 3%. All of a sudden, your 4% bond looks way more attractive, right? So its price on the open market will likely go up. That means you could potentially sell it for a profit. That's called a capital gain, and that's your offensive play. So given this really unique profile of defense and offense, who is this investment actually for? Let's take a look at the types of investors who might benefit the most. Let's see if any of these sound like you. For retirees, that stable, predictable cash flow can be absolutely crucial for covering your day-to-day expenses. For more conservative investors who get a little nervous during those big market swings, these bonds can really help smooth out the ride. And honestly, for anyone who's maybe a little too heavy in stocks, they're a classic way to diversify and not have all your eggs in one basket. Now, you might be thinking, this sounds great, but isn't buying individual bonds kind of complicated? Well, in the past, it could be. But today, getting started is actually surprisingly easy, all thanks to some modern investment tools. And here's the best part. You don't have to go out and try to pick one single company bond. Instead, you can buy something like an ETF or a mutual fund. Just think of these as big baskets that hold hundreds of different investment-grade bonds all at once. This gives you instant diversification, so if one single company has a bad quarter, it's not going to sink your entire investment. And to make this super concrete for you, you can go look up real-world examples right now. Tickers like LQD or VCIT. Those are popular ETFs that focus specifically on these kinds of bonds. It makes getting into the entire bond market just as easy as buying a single stock. So, as we wrap things up, it really all comes down to this question. Investment-grade bonds are this uniquely versatile player. They can provide stable income, act as a defensive cushion, and even offer some offensive firepower. The only question left is, what kind of role could a team member like this play in your portfolio?